Many people understand how much they can contribute into a pension each year, but if you're not sure, then check out my video which explains the annual allowance rules. But what about your employer? How much are they allowed to contribute into your retirement savings pot? Well, the first thing to know is that employer pension contributions are paid gross, and it is the employer, not the pension scheme, that claims the tax relief. The basic rule for any employer contribution is that it must meet the wholly and exclusively rule to qualify for tax relief. So like any business expense, to be an allowable deduction against profits, pension contributions have to be made wholly and exclusively for the purposes of their business. Basically, this means that the contribution should be at a reasonable level for the individual concerned. There are no restrictions on the level of the contribution that can qualify for tax relief, provided it is for genuine business purposes. Unlike personal contributions, the amount of tax relief is not restricted by salary. So in a nutshell, personal pension contributions cannot exceed 100% of your earnings up to a maximum of $40,000 a year. With employer pension contributions, it's not uncommon for directors especially to have employer contributions that exceed their salary. If the local inspector of taxes were to query a contribution, they would look at your total remuneration package. That would include your salary plus employer contributions plus any other benefits that you receive, and ask if you are worth that value to the business. If the answer is yes, then the contribution should be allowed. I mentioned that tax relief on your employer's contributions is unlimited, but it is important to remember that you are still subject to the annual allowance. So if your total contributions, both personal and employer contributions across all pension schemes, exceed your annual allowance, then you may have a tax, or you will have a tax charge to pay. When it is an employer contribution that tips you over the limit, then you may still want to receive the contribution and pay the tax charge if there's no alternative remuneration being offered by your employer. Remember that in certain circumstances, your annual allowance may not be 100% of your earnings, up to the maximum of $40,000 a year. If you have adjusted income over £240,000 and a threshold income over £200,000, your annual allowance will be reduced due to the tapered annual allowance rules. And if you earn over $312,000 a year and your annual allowance is just £4,000. The other scenario where your annual allowance is reduced is when you have flexibly accessed your pension pot, and then you may be subject to the money purchase annual allowance. Check out my specific video on those restrictions in the description below. You may wonder whether your age impacts on how much your employer can contribute into your pot as you get older. Well, the rules state that if you are still working, then there's no issue with you continuing to receive employer contributions. However, after age 75, personal pension contributions are no longer eligible for tax relief. Thank you for checking out my YouTube channel. I'm Justin King. I'm a chartered and certified financial planner, and my aim is to help you live a successful life. That often involves understanding your money, and I hope you've enjoyed this video. If you have, please press the like button to help more people like you find my channel. For now, I'm Justin King, helping you live your best life.